Hello and welcome to the Wealthologist Live with Chris and Jacob. We're doing things a little bit different today because instead of having the financial planners on board today, we're just going to make it all about the market because I don't know if anybody else has been paying attention. It's gotten a little bit crazy. Crazy and just a lot of stuff going on. And we're going to talk about that. We're going to talk about the Fed. We're going to talk about geopolitical stuff. And then I think importantly, we're going to talk about what we're trying to do and accomplish in our portfolios so we can give some clarity. But as we wait for folks to come in, I always like to tell a story. And here's my story, Jacob. Everyone, I was terribly insecure today before this because last week I had to have some dental work. And Jacob will attest to this. Dental work that caused me to have a swollen cheek, unlike it looked like somebody hit me with a baseball bat, didn't it?
It did.
And
it was swollen.
It was swollen. And the unfortunate thing was, it was also the weekend that Corey Sundstrom, who is one of our senior wealth managers and our director of financial planning, it was his wedding. So I got to show up to Corey's wedding, maybe not looking as svelte as I wanted to look. You know, I've been trying the past number of months to lose weight and to be just healthy and like try and get there. And then I show up to poor Corey's wedding, and I'm guessing that most of the pictures Chris is going to have not as bad as it was on Friday, but still not too pretty. Anyhow, I was a little bit worried about today, but I think we're good. I've got a dentist appointment after this to make sure things are good, but I feel like hopefully you at home, you're not seeing anything too goofy. Anyhow, again, I want to welcome you to the Wealthologist Live. And thank you for joining us. Today, like we said, we're going to dive into the market and the economies because between what's going on with interest rates and, you know, the talk of soft landing versus hard landing still with recessions and what that means. And then we throw on top of that things going on in the Middle East, which we have not had a chance to talk about yet. We've got a lot to unpack. So Jacob, I know you got a lot to share with us today. We're going to go ahead and dig in. So let's start with the Fed, if we can. Is there anything that from this most recent meeting that happened that's kind of the stuff that we need to pay attention to, or maybe the blinking lights that say, hey, here's some things that we're looking forward to in the future?
Yeah, no, great. It's a great question. I think it's something that, you know, when we look at what the Fed's doing, obviously we pay very close attention to what they do because they do drive policy, and the actions that they take today do have a tremendous impact moving forward on the markets and the economy. So it was interesting. You know, they met a couple weeks back at their November meeting, and all the policymakers agreed that interest rates may need to remain restrictive for some time. But they did mention...
What's that mean?
Yep.
Come on now. Not everybody knows Jacob lingo. What does restrictive mean?
Yeah. So if we think about where interest rates are, you know, we were in an environment a year and a half ago where we had almost near zero interest rates. So, you know, borrowing, you could go out and buy a car or a home, and it almost didn't really cost you anything. Now we're in an environment where policy and interest rates are much higher, as we all know. So we're pushing almost 8% now on a mortgage, and a little bit higher than that for a car loan. So that's the restrictive nature of interest rates that we're chatting about. So
there you go. You're welcome. Just as a quick aside, I just want to throw this out there because I was just on TV talking about this yesterday. One impact of the interest rates, and I know I don't think we're going to touch on it today, but it's the impact of how it leads to, you know, our government's debt. Obviously, as a country, we're $33 trillion in debt, and we pay interest on that. The Congressional Board came out with their kind of their assessment of everything, and they said the number one biggest or fastest growing line item to the United States budget over the next 3 decades is going to be interest payments, not principal, just interest payments. And it's so big, Jacob, and I know you're like, Chris, I've got stuff to talk about, but this number is so big that they assume by 2053, so 30 years from now, that the interest payment alone, just the interest that we're going to have to pay to service our debt as a country, will be $5.4 trillion per year. Now, to put this into perspective, that's more than we spend on Social Security, Medicare, Medicaid, and defense combined. This is a number, and I bring this up because we have the short-term numbers that you're talking about, but long-term, everybody that's watching, we've got to keep in mind that this will translate in some form or fashion to tax policy as well. We've got to assume that at some point taxes will go up. All right.
Yeah.
Off my soapbox.
No, you're good.
I know.
You're good.
Let's talk about.
He's here to keep me in line.
Yeah,
So.
you got to keep me in line. Apparently, I'm going to keep this going.
Well,
right, go ahead, bud.
To Chris's point, I mean, it really does continue to be a balancing act, and the Fed, I think, they're finding themselves in this debate of whether or not they're going to be able to engineer, this soft landing that everyone talks about. And what I mean by that specifically is just, can we have rates that have been risen so much? Can we get to that level and then still move forward in the economy without pushing ourselves into a recession? And, time will tell. It remains to be seen. But, based on some research that we do and based on our opinion, we do feel that the chances of a mild recession moving into next year, are higher than it not occurring. So it is something that we're paying attention to and that we have to be very mindful of.
I think it's interesting, though, because, if you think back even 6 months ago, it feels like everybody was hitting the gong of like, hey, this is for real recession.
Yeah.
And it's interesting to hear that people are kind of now saying, okay, we know we're probably going to deal with something, but it may not be, as hard as we thought, which is comforting, but we also don't want to let our guards down.
Yeah, and I think that it is interesting because we talk about a mild recession. It's like, okay, well, what does that really mean? And to the point that Chris just made, it's interesting because we've had a much stronger economy than we thought towards the end of last year, when everyone was calling for, we're into recession now and things are really difficult. But we've had jobs that have been really robust. We've had consumer spending that has also been really strong. Now, that's not to say that we are starting to see some of that kind of tip over a little bit, and that's part of the reason why we're still being cautious. But there's a lot of variables and a lot of dynamics at play at this point. One other thing that I wanted to mention, just specifically around the Fed's meeting, their forecasts, they issued their forecast and showed that about 12 of 19 Fed officials, they've projected about one more rate hike this year. And they also said fewer rate cuts in 2024 and 2025. So that does really solidify their stance in that we may be in this higher for longer environment. And again, we'll see how that all pans out. But I do think that there's a pretty high likelihood we see probably one more rate hike either this year, maybe in January. But if we do move into a mild recession, I think we are going to see some pretty aggressive interest rate cuts at that point. So we'll see how that pans out. The only other thing too I wanted to mention, just as it is, when we're talking about interest rates, we know that bonds and interest rates are kind of on a seesaw. If I think about the dynamic between interest rates and what the price of bonds do, it's like being on a seesaw. They're inversely correlated. So, if interest rates are going up, that's not real good for the price of bonds in the short term, but vice versa. When cuts happen, that should be good for the price of bonds. So that dynamic is at play. And it's part of the reason why we want to pay so much attention to the Fed, because we do feel that if we were to get interest rate cuts into next year, that would be a positive environment for fixed income, which is something that we're seeing is much more attractive now than it has been.
Yeah, interest rates, bonds are obviously paying more, and if the Fed starts cutting rates, the value of bonds will increase. So we might see within portfolios some increases towards fixed investments accordingly. So let's move on to, I think, another big topic, which is around geopolitical.
Yeah.
Obviously a lot going on in the Middle East. I want to dig in. What are the big areas that we need to focus on most with what's going on in the world today? Yeah,
no, I think it's important. And to Chris's point earlier, we haven't really had a chance to talk a lot about these things that are happening. Obviously, the atrocities that are occurring in the Middle East and Ukraine, it's so sad. I can't really even imagine what it's like to have to deal with that. And we're blessed to be, in the U.S. But our thoughts and prayers certainly go out to those folks who are impacted by that. But I do think it's important. We're in a somewhat of a fragmented world at this point, and so we're seeing more extreme fragmentation by large world powers. And what I mean by that is really just there's less cooperation and collaboration to limit conflict, it seems, now than maybe it was in the past. And so problems are not going to get solved as easily. But I think what's more important is for us, it does mean that we, probably are moving into a more expensive world, which just means from an inflationary standpoint, that's something we're going to have to navigate and deal with for some time. Not the end of globalization, but it certainly is a rewiring, I think.
Well, even right now, they're talking a lot about the meeting between Biden and Xi Jinping, and how the Chinese economy has slowed down dramatically, and interestingly, China's in kind of a weaker position because obviously they've been strong because we've used them a lot, but because the shutdowns from the pandemic, that's really kind of weakened them and kind of put them into a little bit of, I don't want to call it a submissive type position, but definitely not the powerhouse that they were before. To see their economy shrinking, they're looking at the U.S. right now and kind of saying, hey, we kind of need you to breathe some life in us.
Yeah. And I think they're still, certainly a force to be reckoned with, but they are in a different position now, certainly, than they were or have been in the past.
It's kind of like the bully at school when when somebody punches back, they're like, whoa, hey, okay. Sorry.
No, the other thing that I want to mention just from a geopolitical standpoint too is, energy still is one of the main concerns that, we're paying close attention to. I mean, the good thing is we have not experienced any sustained production issues from what has been happening. And there's sufficient capacity to deal with most of those issues. Usually, in this type of an environment, when we see these things occurring, you see some immediate price action with energy prices, whether it's crude oil or natural gas or what have you, and then volatility subsides. I think the main risk, which all of us are paying close attention to and monitoring, is if the risk were to broaden, into what we would consider more major escalation. That could be an issue and something that we want to be, again, just watching carefully. So I think the key with this is to diagnose what type of shock that we're dealing with. Is it a geopolitical shock, just a geopolitical shock, or is it a geopolitical shock with energy issues? Long story short, if it's a geopolitical shock with energy issues, that's where we have to watch out, because that's when we get increased energy prices. And I think the correlations between asset classes can sometimes break down, which is not what we want to be dealing with.
So I think obviously a lot of our clients and folks that aren't clients but might be tuning in, this all translates to what does it mean within portfolios? How do we begin to change perspective or adjust portfolios accordingly to make sure that for our clients we're taking care of that money? Yeah. So what's that look like right now?
Yeah, no, it's very relevant question. I think the one thing I was going to mention, I actually had internally, we had some communication back and forth when a lot of this was going down with the Middle East, and just talking about what it means, how we position ourselves, how we move forward. And I mentioned that the unfortunate reality is that we will have tough periods, whether it's crisis or catastrophes. We've all witnessed recessions and terrorist attacks. And the thing that I find myself trying to be confident in, I say trying because it's not always easy, but is just knowing that the human race always advances forward, and the survival gene for us, as humans, it is the fuel for advancement. So I say that just because I think it is important when we're trying to make decisions around portfolios and how do we allocate based on what's occurring. We never tend to make great decisions out of fear. Doesn't mean we're not supposed to be watchful and careful. And again, I'm not discounting, what's going on in the Middle East, because it is very, very sad. But I just want to mention that because I think it is important to have that perspective. So in light of, some of these events, a few of the key positioning that we've made in our strategies, we've added to some of our energy exposure, just because if things were to escalate, we want to make sure we have some hedges in place if energy prices were to go higher. So we've added to some energy exposure. We've decreased some of our international exposure as well from a stock and bond perspective, just because, we don't know, there is still some uncertainty. We don't know exactly how all of that's going to pan out. And one of the allocation adjustments that we've made that has been good for us so far, just over the last month and a half, because we have seen some decent pickup in the markets, is just adding to some of our larger cap stocks in the U.S. that have appeared to have more
Now, larger-
attractive growth profiles.
Larger cap.
Yep. So large cap just meaning, Chris is keeping me on point. Larger cap just meaning large companies. So think of, if you're comparing I don't know why Kmart is coming to mind because it's not even in business. Walmart versus Kmart. Yeah. I'm thinking of a small company. So, Walmart versus like a mom and pop store that sells the same type of stuff. So obviously the Walmart's a very large cap company. So your Walmarts, your Apples, your Googles.
Yeah, kind of blue chips fall into the large cap world. But again, I think we sometimes talk about a large cap, small cap. It's got to slow it down a little bit. Jacob, I appreciate the input and insight that you threw out there. And I know you talked about adding energy exposure.
Mm-hmm.
You talked about decreasing international exposure in some areas that could be. I guess in a little bit more detail, what does that look like? How does that really impact the portfolios that our clients are looking at? What are they going to see on their statements? How does that translate?
No, that's a great question. I think just from a perception standpoint, you will likely see on your statement some buying and selling within the position. So we use mostly ETF securities, which just stands for an exchange traded fund. It's like a stock, it's traded on the exchange, but it's a cost-effective way to hold an investment. And so we make those changes and adjustments within the ETF securities that we hold. And it would just be simply a buying or selling that you'd be seeing on a statement when you look at the statement.
All right, cool. Well, thank you, Jacob. Yeah. And you get to stick around for the segment we lovingly call Hey Hobart. And this is where we take questions from the audience. And today we're not taking live questions. We had somebody send in a question that we thought it'd be easier. Plus, we're using a new platform today. Please let us know how you like the new platform. We are doing this directly through YouTube. We're hoping it makes it a better viewing experience for all of you. And so far, for us, it's actually worked out pretty good. I like this so far. But if you have any questions that you want to have answered through Hey Hobart, all you got to do is send them in to us at heyhobart@hobartwealth.com. And if you are lucky enough, we might just feature one of your questions on one of these events. So today's questions that we got, which I love, as we head into the last 2 months of 2023, I guess it's actually a month and a half now. What financial steps should I be thinking about to finish the year strong? I think that's great. And this is one of those things that we got to talk about. Okay, the markets are going to do what they're going to do, and you've touched on that. So regardless of what the markets are going to do, there's a few things that you can do at the end of every year to make sure your house is in order. And a lot of those things happen to do with taxes and putting yourself in a position to potentially save on your tax bill. And we might look at several strategies, including, in fact, we talked about this at lunch today. Jacob and I grabbed lunch with our COO today, and we talked about tax loss harvesting. What we do every year for clients in their non-retirement accounts is we take a look inside their portfolios. Are there any investments that didn't do well this year that they might do well, but we're going to go ahead and sell them to take any loss on those investments in order to help offset any gains in a portfolio. So I think, again, we're doing that automatically inside your portfolios if you're working with us. We'll also generally look at your asset allocation and determine if there's any asset that has a gain that we want to offset against something else that has a loss, and that way it kind of wipes itself out. You also might think about making qualified charitable distributions for tax deductions. So if you're the age that you're getting required minimum distributions, or what are called RMDs, and you don't need that income, you might want to look at donating that money to a charity directly and reducing your taxable income that way. I will tell you, if you've got questions, if you're of the RMD age and you're giving money, this is kind of one of those things that you just should be doing. Our financial planning team, Corey, Andrew, and Nick, typically talk with everybody and to find out if that's the case. But if you're giving and you're also taking RMDs and you're not doing it efficiently, this is a great way to really cut Uncle Sam out of the picture on some level. I'm a fan of everyone paying taxes, by the way. Don't cut Uncle Sam out and do it illegally. But this is a legal way for people of RMD age to give directly to charities and help themselves from a tax perspective. Jacob, anything else that you can think about? Again, your position has changed. You're still a CFP. You're also a CFA now. But from your perspective, anything else that you would say at the end of the year we should be thinking about doing?
Yeah, I think you hit on a bunch of really good topics. I mean, the tax loss harvesting piece, the qualified charitable distributions. Those are very important. The things that we're doing on behalf of you that have entrusted the money to us to invest and manage appropriately, we're obviously looking forward and saying, okay, well, what are we expecting in 2024, and what is the outlook, and where do we think interest rates are going, and of course then the market. And so we're behind the scenes making those allocation adjustments and changes, and we're likely going to be making some of those towards the end of the year. So those are probably my parting comments as far as the things that we need to be looking at. And of course, that's something, when I say we, it's us helping you at the end of the day.
I would say the one thing that I'll throw out there just for consideration as well, as a busy time of year, obviously, but we're also dealing with a lot of family and everything. One thing that might be a good idea during this time is just to review your beneficiary statements, beneficiary statements of your retirement accounts. If you have payable on death accounts, making sure that those beneficiaries are correct, and also just revisiting any life insurance policies that you might have, because again, you just want to make sure that that money is directed in the proper areas. And this is a big mistake we've seen when new people come to us and we go through their beneficiary statements and they say, I didn't realize I was still giving, my IRA was still pointed towards my ex-wife. We've seen that before where people are like, oh, that's not what we planned. Good time to check and just make sure everything's squared away, or ex-husband, or it doesn't even have to be an ex. Maybe it's I
was gonna say, we just had as many of you guys know, we had our first, baby boy, and he's 4 months old or 4.5 months old. And we're still scrambling to get our will done and our estate planning documents. So it is important to be paying attention to that.
Yep. Just if nothing else, it's a good way to make a to-do list for 2024. Yeah. So if you're watching today, it means that you're either already a client of ours, or maybe you're interested in learning a little bit more about what we do. Either way, it's our goal to be your source for all things financial. If you've got specific questions about topics that we've talked about today, or you've just got questions about your specific financial situation, we're always here to help. Myself, Jacob, the financial planning team. Also, we tend to hold different events talking about taxes, Social Security, income generation, investing. If you're interested in attending any of those, you can always give us a call at 888-553-0122, or send us an email at hello@hobartwealth.com, and we'll get you on that invitation list so you can always attend that. As always, you can call or email us anytime with your questions about retirement income, investing, taxes, anything related to your money. That's what we're here for. That's kind of sounds nerdy, if you will, but it's kind of what we enjoy. That's what we do for a living. So use us. But thanks for coming today. We look forward to seeing you at our next Wealthologist live event in December. And during that one, we're going to be bringing some more great insight around wealth, around financial planning, and around your money. Until then, have a very happy Thanksgiving, and we look forward to seeing you soon.